The banking system is ripe for another crisis. Now, I know what you're thinking. Tell me something that I don't know. Well, I'm going to show you just how bad it is. This is going to be a really quick video, and I wanted to show you one of my best sources that I found here as of late for getting up-to-date news on the financial markets and current events. So without further ado, I'm going to get right on into it. I'm going to make this video really quick, but for those of you that are new here, please make sure that you subscribe, hit that notification bell, and if you like our content, make sure to hit it, and then drop a comment down below and let me know what you guys think of this ongoing banking crisis. Now, let's take a look here. First, I wanted to share a tweet from our good friend Marcel, the Butcher of Wall Street, giving us an update on this reverse repo falling a massive $314 billion. Last Friday, the end of 2023, money market funds and institutions pumped the reverse repo to over $1 trillion again for the first time in months, as institutional bankers locked in their 2023 year-end bonuses. Today, liquidity collapsed to more realistic levels, proving that injections on Friday were simply a facade, putting lipstick on a pig. This shift in RRP seems to coincide with collateral from these banks' funds listed in red that became 100% worthless May 2nd, 2023. Total RRP users also fell from nearly 100 to 78 over the weekend. Now, he shows us, there's this change that they had made back in May of 2023 as far as the collateral that some of these banks and funds held, okay? And basically says that the total RRP users also fell from nearly 100 to 78 over the weekend, right? So this is a moving, I guess you would call it a fluid or liquid situation. This is an ongoing liquidity crisis. And we've covered how the other backstop that they set up for the banks was the BTFP, the Bank Term Funding Program, and that is set to end or expire on March 11th of 2024 here. So that's coming up as well. And that was a program that they implemented last March when the banking crisis got started again. The banking crisis never ended. As you can see, it's an ongoing liquidity crisis. And now we have our own federal government issuing a study on how the banking system is ripe for another crisis and remains fragile and uncertain. Now, take a look at this one, folks. Sorry, right there. And I wanted to share this source here. This is a really good publication that I found here as of late. It's Wall Street on Parade is what it's called, a citizen's guide to Wall Street. They do a good job of breaking things down and simplifying it. For a guy like myself, that's nice. wallstreetonparade.com. But I'm reading from this article right here. Federal agency study contradicts Fed chair, finds banking system is ripe for another crisis and remains fragile and uncertain. This is from Pam Martins and Russ Martins. It's like a husband and wife tag team duo here. Following the second, third, and fourth largest bank failures in U.S. history in the spring of last year, and remember, actually, I forgot to mention, we just saw the 1-month Treasury T-bills just went nuts, right? The last time that happened was right before Citizens Bank and First Republic went bust as well. So we're already getting the signals and the warnings that are going off. But once again, Federal Reserve Jerome Powell gave his semi-annual monetary policy report to the House Financial Services Committee and the Senate Banking Committee in June. During both appearances, Powell stated the same thing. The U.S. banking system is sound and resilient. Of course he did. Going to achieve that soft landing too while we're at it. But according to a report last week from the federal agency whose mandate is to keep federal regulators apprised of the true condition of the U.S. banking system, it is actually ripe for another crisis, and its condition is, quote, fragile and uncertain. The federal agency whose researchers are taking the latter position is the Office of Financial Research. The agency was created under the Dodd-Frank financial reform legislation of 2010 to prevent another 2008-style financial crisis by providing federal regulators with ongoing analysis and warnings on systemic risks to financial stability. Now, I love that, right? We got a government agency here reporting back to us and letting us know that the system is in fact still fragile and uncertain after their whole agency was created after the Dodd-Frank Financial Act that was set to rein in the banks and, solve the banking crisis and, the whole issue that we had during the Great Financial Crisis, right, in 2010. Now, here we are over a decade later, and they've let this thing blow back up once again, and now they want to come in and warn us. Oh, guys, it actually is still fragile and uncertain. And uncertainty is the word of the year, the word of, the last few years, as Jerome Powell's been able to open up Powell's Pandora's box back in 2020, making that money printer go burr at a pace that we'd never seen. They cut interest rates to zero. And then he raised interest rates at the fastest pace that we've ever seen on the flip side back in 2022. And that's what rug pulled Main Street in our U.S. economy and what is sending us into a recession now. Now, they've been able to rein back in inflation, and they want to act like they've won the fight against inflation. And meanwhile, we know, of course, the system's still fragile and uncertain. Of course, real inflation is much higher than the 3% you're reporting, but it's also just bottoming out before it goes back up on another leg, and it might go back and achieve more than the 9.1% that we actually did back in 2022. And see, the actual problem now that we're experiencing is stagflation, where prices are still going up, even with demand falling off. And so, I mean, tell us something that we don't know. The system's still fragile and uncertain. We're watching how much you guys are moving out of the reverse repo, how much you guys are using all the BTFP, and we see your balance sheets, right? The banks across America have $684 billion of unrealized losses. The Federal Reserve itself has $130 billion. As I just dropped the other video, we now have a $34 trillion ticking time bomb for the U.S. government, national debt, on top of the $120 trillion of unfunded liabilities, on top of the, $8 trillion of bonds that are set to expire in the next year. We're going to have ourselves a good time, folks. Strap in. It's fragile and uncertain. Yeah, thanks. It should be noted that the OFR researchers' findings are consistent with the credit ratings agency Moody's. Yeah, folks forget, right, that Moody's, which downgraded the entire U.S. banking system to a negative from stable on March 13th of last year. They haven't changed that. We're still at negative for our, credit rating of our banking system. And I don't know what's worse than negative. I mean, can you say bust? They want to say fragile and uncertain. Can you say bust? We need a full backstop. Otherwise, we're bust. That's where we're at. The OFR's slapdown of Fed Chair Jerome Powell's Goldilocks view of U.S. banks came in a research brief released last Wednesday by the OFR research principal, Peyton Young, and OFR financial analyst, Tom Doolittle. In one deeply troubling paragraph, the pair wrote, quote, "Many of the conditions that precipitated the 2023 banking crisis persist." You think? Fair value losses in bank security portfolios are still large, $684 billion. Deposits continue to decline. Absolutely. Bank equities are underperforming, and the higher interest rates that catalyzed the banking crisis in the first place have not abated and may even increase further. And that's the problem here, is that if Fed Chair Jerome Powell wants to even have a chance at fighting this inflation, he's going to have to keep the rates elevated higher for longer, which he has, said. He's careful to say that too much. He doesn't want to spook us. He doesn't want to scare us. He wants us, to still be having a good time. In another paragraph that carried the headline, quote, "Banking conditions remain fragile and uncertain," the OFR researchers wrote, quote, "Some banks remain pressured by conditions similar to those that precipitated the bank failures earlier in the year, including large fair value losses in securities portfolios and a declining base of deposits. Since 10-year Treasury rates increased in 2022, banks have posted significant fair value losses in their securities portfolios. As of Q2 2023, banks' fair value losses on securities totaled over $558 billion. Now, as we know, that number is actually now at $684 billion. It's actually more. A 10% discount on their amortized cost. In addition, rising short-term rates have catalyzed continued deposit outflows from the banks since Q2 2022. Approximately $1.3 trillion of deposits, or 7% of total deposits, have been withdrawn by customers primarily due to more attractive yields on other investments such as money market funds. So folks are going to short-term T-bills, 1 month, 3 month, 6 month. And then they're also going to, 1 year, 2 year bills. And then you're seeing folks that have even gone into longer bonds as well. I mean, this is the first time in a very, very long time that you're getting any sort of rate of return. They're actually trying to get you into high yield savings now at most banks, right? They're trying to say, hey, keep your money here. Now we can give you a little bit of a return. A key purpose of the brief was to recommend 2 forward-looking metrics that can identify banks that are vulnerable to future fair value losses before those losses are crystallized. Wasn't it? It was Bank of America, right? That has over $100 billion of unrealized losses on their balance sheet. Guys, this is just on their bonds. This does not include the toxic commercial real estate debt that they have as well. There's probably a little bit that's residential toxic debt there as well. Not as much as the Great Financial Crisis. But with the commercial implosion, the commercial sacrifice that's underway, the $684 billion of unrealized losses does not include that. They have over $2 trillion of commercial mortgage-backed securities that need to be reset, restructured, and refinanced in the next 2 years. So talk about a ticking time bomb. There's a couple trillion there that needs to be reset. And but what we found far more interesting about the brief was its silence on the biggest threat to financial stability in the U.S., the mega banks on Wall Street. The 2 researchers acknowledged the following, quote, "The 2023 bank failures provide a foretaste of what could happen next. Concern over the safety of uninsured bank deposits may lead to substantial customer withdrawals that shrink a bank's capital base, necessitating deleveraging to meet cash outflows and regulatory capital requirements. This, in turn, the researchers write, could, quote, require these banks to realize or potentially realize fair value losses on their securities portfolios. This could further exacerbate the loss of confidence in a bank, leading to eventual receivership." This is like the Basel requirements, and everybody, a lot of people in our community have been talking about this, right? The update Basel 3. Next one is Basel 4, and the capital requirements and the collateral that you have to have. You got to up your game. And what's going to happen here is this could actually force selling. This could force them to realize the losses because they have to sell these positions and they have to get more good collateral. At the time of their failure in the spring of 2023, Silicon Valley Bank held approximately $175.4 billion in total deposits. Signature Bank had $88.6 billion, and First Republic held $103 billion in total deposits. Those failures started a systemic contagion effect, forcing the Fed to create yet another bailout program, the Bank Term Funding Program. And we've been talking about that BTFP, haven't we? And how it's set to expire. But compare the amount of total deposits at the 3 banks, $368 billion, to the systemic risk posed by the largest bank in the U.S., J.P. Morgan Chase. And do you think that Jamie Dimon cares? Not in the slightest, because he knows that they're going to get bailed out. He knows that they're going to be given a backstop by Janet Notel and Yellen. Janet's right there behind him, rubbing him down. I should be careful with my words. She's right there. Don't you worry, Jamie. We got your back. Thanks, Janet. Appreciate it. Yeah. According to JP Morgan Chase's call report with its banking regulators for the quarter ending June 30th, it had $1.04 trillion in uninsured deposits in its domestic branches and another $437 billion. That's just dwarfing what these other banks had, right? Another $437 billion in deposits in foreign offices that lack FDIC insurance. Bringing its total deposits that lack FDIC insurance to $1.48 trillion. That's about $1.5 trillion of uninsured deposits at JP Morgan Chase. Yikes. JP Morgan Chase's uninsured deposits represent 59% of its total deposits of $2.5 trillion. That's over half of their deposits are uninsured. Despite JP Morgan Chase's stunning threat to financial stability, no banking regulator has had the courage to publicly recommend breaking up this behemoth. Serially charged bank, notwithstanding an international bank study using 150 years of data showing mega banks produce financial instability and more severe banking crisis. It's time for Fed Chair Jerome Powell to start telling the truth to the American people or step aside and make room for someone who will. Yeah, it's going to be interesting to see how much longer we have Jerome Powell serving us. We act like we serve us. He's an unelected official here serving the private central banking elite, right? And therein lies the problem. And so in the meantime, how do we position? I've been talking about precious metals as how I'm saving. I'm staying liquid with cash. I'm definitely not keeping more than $250,000 in any one bank account. I'm going to, split that up. But I've been stacking silver for my savings. I've been stacking cash. I keep some of it out of the bank. I don't keep more than $250,000 in any one account. And then I understand that the solution, as always, never let a crisis go to waste and never let your banking buddies die. Now with the new rules, they'll do bail-ins is how they've set to do it, which is why we can't keep too much money in the banks. And if we turn back on the money printer and we have to cover this thing up and paper it back over, that inflation comes back and the assets that we own are going to be rip-roaring once again. So that's the good side of this opportunity. The bad side is that everyday inflation is not going away. It's going to keep persisting. And for us, you got to really get tactical with your wealth right now, as far as how you're making it, how you're keeping it and protecting it, and then how you're going to multiply it. So that's why you need to subscribe, hit that notification bell if you're new here. Make sure you stay tapped in with us. All of our community resources are available at my website, zachrector.com. If you want to be able to get in direct contact with me, you want to be able to ask me questions, you want to be able to talk about your business, talk about investments. I'm not here to give you financial advice at all, but I'm willing to talk about different ideas, different investment theses. I'm willing to talk about the current events and whatever else you might want to have a conversation about. We have weekly calls every single Saturday, okay? And we're getting ready here. We got a couple Discord meetups. We're actually going to be meeting in person. Really looking forward to that. So get tapped in with us, or just keep showing up here on a daily basis. Drop your comments down below. You guys know that we keep on doing live shows at least a few times a week. Stop on by, ask your question, and we're here to help out folks who are just trying to survive what is definitely going to be an ongoing banking crisis. But what it really is some bigger issues. It's a debt, currency, and liquidity crisis that is not going away. And the average American doesn't even see the financial tsunami that's already hitting. It's already here. It's already hitting. And some folks have already started to drown out, but folks are underestimating how big this financial tsunami is. Okay. So with that being said, guys, if you appreciate this video, make sure you like it. Make sure you drop a comment down below. Let me know what you think about this situation, and we're going to keep the updates coming. I'll see you guys in the next one. God bless you all.